Welcome back. Thank you for watching another one of my videos. This one's on Netflix. So Netflix stock price has plummeted recently. I don't think I really need to tell you that. I'm sure you knew that already if you clicked on the video, but over the last month, they're down close to 40%, okay? So that raises the question, is this a great buying opportunity? So what we're gonna do is try to answer that question by looking at the financial statements and then looking at their letter to the shareholders that they published recently, using that to try to look at some of the key variables and build out a valuation for this company. All right, let's get started. So before I start, I want to talk about the quote up top because that came from Warren Buffett and it was in response to a question where somebody said, how should I teach business valuation? And he talked about how whenever he was learning under Ben Graham, what they did every day in school was just go over company after company after company. And in the video clip where this quote comes from, Charlie Munger jumps in at the end and says something like, if you're doing the same valuation for every company, you're doing it wrong. You shouldn't be able to value everything just doing the same exact method. And I've talked about it before, but my outline section here is going to be different for every company. Okay, because each company is different and there are different things that you want to pay attention to. Like for example, Netflix, they are going to have amazing revenue, amazing earnings. It's just going to be outstanding past performance as far as financials go. The question here is going to be, are they overvalued? That's what we're trying to find out. We're trying to predict their future income stream, discount that back, and see if that's at a fair value or not. For somebody like them, I'm not going to spend a ton of time diving into all their debt and seeing when the debt's coming due, how much interest they're paying. I'm not going to be looking at their price to book value and saying, oh man, they're selling 10 times over book. That's terrible. I'm not really going to care if management's not buying back shares because the revenue's growing so much that I'm expecting them more to use their money to reinvest into their growing business. It's completely different from, like, let's say a manufacturing company, which is actually the industry I'm more familiar with. For example, manufacturing is going to be cyclical by nature. In that case, I would look at things like the debt load to make sure that if they had a down year, a down cycle, that they wouldn't go under. I'd look at their equity per share to make sure that I have a decent floor on my share price, like for a net worth that, even if they were to liquidate, I'd still have some value. And I'd look to see if management's buying back shares because in those cases, usually big manufacturing companies, if they're undervalued, management can get a better return by buying the stock back than reinvesting in these super expensive assets. But anyway, I'm going off on a tangent. If you want to see a good example of that, I think my Smith & Wesson video does a good job of that, and I've already said that's one of my top holdings. And it wasn't even one of my holdings until after that video, so I think it's pretty interesting to watch. All right, total revenue first. Look at this growth. This is insane growth. I mean, they've gone from $1 billion in 2012 to over $7 billion in 2021, the end of 2021, 7 times in 10 years. That's an insane growth rate. Look at that. If I do 7 raised to the 1/10, that's how you annualize a growth rate. That's 21.5% revenue growth on a year-over-year basis on average. Insane. All right, let's look at their margin. So not only is their revenue growing, but look at this. Holy cow, margin is growing too. So it's really rare to see revenue and margin growth, because usually if you're growing revenue that much, you're doing it at low margins because you're investing so much into growing that revenue. So to see it like this is just, like I said, they have amazing financials. All right, and then we'll look real quick at their pre-tax income. It's got the same pattern. Look, if your revenue's going up and your margins are going up, your income's going to be on an exponential, and it is. Look at that. Wow. All right, earnings per share. I want to get a recent earnings per share number because I'm going to use this later in the valuation. I'm going to be optimistic here and take the average of the last 3 quarters and then multiply by 4 to get my estimate for the yearly income. All right, so if I do that, average of the last 3 is $3.30. So 330 times 4 gets me an estimated yearly earnings per share of $13.20. So I'm going to write that down over here, $13.20. All right, on to the balance sheet. First up is total equity. We say you always want to look at this because it's like the net worth of the company. And I mean, look at this. It's on an exponential. That's great, right? I mean, how'd you like it if your personal net worth looked like this? I mean, probably have less zeros, but I'm just talking about the pattern itself. I mean, it's outstanding. All right. So now we're going to look at assets because we want to get a return on those assets. So they have about, let's say $43 billion of assets. And y'all know I like to usually do return on tangible assets. And the reason I love return on tangible assets is because it's like a way of measuring the efficiency of those assets, or how good those assets that you own are at paying for themselves in a way. I always use this example, but like if you're going to start a business, you want to know, what am I going to have to buy in assets and what's my income going to be pre-tax? I think that just makes it super easy to conceptualize. Okay, so I usually use tangible assets. So let me show you their total tangible assets. Total tangible assets are only 14 billion. If you remember, their total assets were 43 billion. Okay, so that's a huge discrepancy. So what's going on here? So in Netflix's case, and in a way, this is also kind of a fault of where I get my data because I just pull it from Yahoo Finance and sometimes their computer system can get confused. They count their rights to content as content assets. That's how they list them. Yahoo Finance counts that as intangible assets because they're not physical things. Even though then they're not real physical objects and physical assets, they're still real assets that are money producing. It's not something like goodwill where it's just an accounting fudge factor, okay? These intangible assets are the rights to the content that Netflix is buying to make money off of, okay? So it has to be included. So this is a great example of like why you can't just use the same exact formulas for every company. Because if you look at some of my other videos and say, okay, he always uses return on tangible assets, and you did return on tangible assets, let me pull it up, okay? You would get this insane number of like close to 50% return on tangible assets. And you would say, oh my God, this is the greatest company in the world. Return on tangible assets is 50%. Yeah, not so fast, right? So in this case, you need to do return on assets because those are assets that are making them money. And if I do that, I get over 15%, which is still incredible, okay? Rule of thumb here, over 10% is good, over 15% is great, okay? So yeah, awesome. All right, let's go to retained earnings. I've never talked about this, but I think it's pretty important and you have to have kind of an understanding of what it is. So this is a cumulative amount in the balance sheet that adds up all of the retained earnings for a company. And it's super important to look at for companies that aren't paying dividends or buying back shares, because what it's telling you is, okay, they're choosing not to return value to the shareholders by not paying dividends and not buying back shares. So the retained earnings and the rate of change of those earnings should be outperforming what you expect to get if they were paying that out. Okay, so what do I mean by that? In 2018, they were at $2 billion of retained earnings. So in 3 years, let's do 4 years. So in 4 years, they went to 12 billion. So if I do 12 divided by 2, okay, so they went up 6 times. I raised that to the 1/4. That is a rate of return of 56%, okay? So their coffers are growing at 56.5% a year. You're not going to beat that. If you're a shareholder here, you do not want this dividend if they're growing like that. You're like, man, y'all just keep doing what you're doing. I trust you with the money more than me. You're getting 56% growth on your earnings. Keep it up. Now remember, this metric's only really precise because they're not paying dividends or really buying back shares. I think they bought back shares one time. But if a company is paying dividends and buying back shares, this isn't going to be that good because they're not retaining their earnings. They're giving it out to you. That does not mean anything bad at all. But it wouldn't be apples to apples if you tried to judge them by retained earnings. So just keep that in mind. All right, on to the cash flow statement. Okay, so here we're also going to run into a little discrepancy with Yahoo Finance, and it has to do with how Netflix classifies those assets that I talked about. So free cash flow is what, right? Free cash flow is your cash from operations, meaning how much money did your business by itself bring into your checking account net, okay? Just the operating business, not counting your debt, not counting your investments, just your business that was running, how much cash did it bring into your checking account? And then we take that operating cash flow, and you subtract out capital expenditures, which is cash that you invested, other assets, or to keep up with your existing assets, besides general maintenance and everything like that. So the issue here is that Netflix shows very little CapEx, and in general, they show very little investing cash flow. So look at their investing cash flow, only 200 million per quarter. Remember, we were on the scale of billions for everything else. So this is really low. And if you look at their like net PPE, purchase and sale, so this is property, plant, and equipment, even though it looks like it's on an exponential, it's still pretty low. I mean, you're less than 200 million per quarter. So it's not coming from that. So what's interesting is if you dive down deeper into the operating cash flow, what you see is there's this huge negative classified by Yahoo Finance as other non-cash items. And all this is the cash investments in those content assets I talked about. So this is how much cash they're paying for the rights to content and stuff. It's called content assets if you read any of their quarterly reports or 10K. In a way, this is actually our real CapEx, all right? Because this is on the scale of, over $4 billion a quarter, not 100 million. So I need to kind of modify the free cash flow here, right? It's not like every other company we've looked at. So to do that, I take the operating cash flow and I want to subtract this number out. However, operating cash flow already has this subtracted out, right? It's part of it. So in a way, for this company, you can kind of use their operating cash flow as an estimate of their free cash flow. As far as how it looks, this is not great. So this is actually our first red flag. If you see cash flow like this, it should be sounding alarms in your head, right? Because they're making a ton of money. They're revenue's growing, their income's growing, their equity's growing, their retained earnings are growing like mad. Where's the cash? Where's the money? It's not as bad as you think, and it's actually kind of by design, and we're going to get to it in the letter to shareholders, which we're going to right now. All right, so let me pull that up. Okay, so this is their investors relation page, and I'll link this page. All I'm doing is coming here to 2021, quarterly earnings, fourth quarter earnings, and clicking letter to shareholders. All right. I love reading letters to shareholders. I think that you can learn so much about a company by the tone it talks to the shareholders. Does it talk to you like you're a partner? Or does it talk to you like it's trying to confuse you with words like EBITDA, or which is like the worst word in all of investing, okay? One check I like to do is like Control F for EBITDA, and if it comes up like 2 times, that's just a red flag. Okay, so let me see, EBITDA. Well, I can't even spell it right. That's how much I hate it. Not found. Congrats, Netflix. Another thing that you can really get a feel for by reading 10Ks and reading letters to the shareholders is what the company views as its own key metrics, right? If you can find 2 or 3 things that the company thinks is most important and you can understand those, that's how you develop an edge in investing in that company. Okay, so you can read this letter, and it's actually a good read. They don't talk down to you, that they don't try to confuse you, and they make it pretty clear that their most important things are this global streaming paid memberships, and this is how many paid Netflix accounts there are at the end of each quarter, and then their margin, their operating margin up here. So I'll just show you real fast. I mean, they mention it a bunch. So here's global net paid ads. That's how many subscribers they added. They talk about paid ads again. They just have it all over the place. And then here, margin as well. So one thing about margin is that they strive to grow at 300 basis points, or just 3% each year linearly. So that means 2020 they were at 16, 2021 they tried 19, 2022 they hope to be at 22, and then 2023, 25, okay, you get it, right? 3% in operating margin per year. That's pretty ambitious, but I like whenever a company has targets like that, and it seems to kind of be hitting those targets. So interesting. So what we're going to do is we're going to use that margin forecast combined with the forecast on the memberships to try to build out a valuation. So let me just show you this chart again, because I think it's pretty important. Remember, this is how many paid memberships they have on file at the end of the quarter. So what I've done is move all of these, including previous years, into an Excel sheet for you. So I'm going to pull that up. All right, so starting with 2019 quarter 1, they had 148, and this is a million paid memberships. 151, okay, I don't need to do all this. But anyway, what I did then is graph it, and the only way I could get this graph to work for what I want to do with it, because I'm not that good with Excel, was to make each quarter a quarter of a year. So the first being 0.25, then the next being a half a year, 0.75, 1 year. You get it, right? 0.25 is 1 quarter. Okay, so this is what the trend looks like. Now, the issue with Netflix is that you cannot really assume a linear growth, all right? They're going to run into a population problem. They're going to run into a market share problem where they have so much of the market share that they cannot continue to grow at the same rate, right? So in order to project it, you have to pick a different curve than linear. And what I chose is a logarithmic curve. So I'm going to fit a logarithmic curve to this, just using Excel's trend line, and then project it out another 5 years. So if I do that, let me pull it up real fast. All right, so here we go. This is a logarithmic graph, and it's pretty conservative, but you can see it kind of follows the data, and it assumes that in 8 years from 2019, so 5 years from now, they'll be at 250 million subscribers. I think that's a little conservative, but remember, whenever you're doing business valuations, it's much better to be conservative and then undervaluate and not swing at a pitch versus super aggressive, get an overvaluation, and then wind up buying something at the wrong price. Okay, so this number, 250 million over 5 years. So if they grow from 224 to 250, so 250 divided by 224 over 5 years, that is about 2.2% growth, okay? That's pretty modest. I think it's gonna be higher than that, but remember, we're being conservative here. So this is a 2.2% growth on membership. So let's say that they raise their prices on average by 3% a year to keep up with, like, let's say inflation. So to do that, I would multiply this by 1.03. Okay, so now we're at a 1.05% growth over the next 5 years in revenue. But remember, they're doing their margins linearly 3% a year too. So if I just add 0.03 to this, and I know my math might not be exact, but remember, investing, half art, half science, right? Okay, so plus 0.03, and I get about an 8% growth rate in income. So I'm gonna put that as my projected growth down here, 8.3%. Now I need a projected pre-tax income. I'm just gonna go back to our income statement trends, pick out the pre-tax income, All right, so let's say we're like 2 billion a quarter right now. If I multiply that by 4 to get to a yearly number, that's $8 billion of pre-tax income per year. I'm going to multiply that by 1.083 raised to the fifth. All right, and I get 11.9 or just 12 billion for my estimated pre-tax income in 5 years, okay? Like I said, these are pretty rough calculations, but I think I've leaned conservative, so it's okay even if they're a little wrong. All right, let's finish this up. All right, so what I do here, I'm going to do my pre-tax income rule of thumb method first. All right, before I start, I know what you're thinking. You're saying, man, he gave this big spiel at the beginning of the video about not using the same valuation for each company, but yet every video we end up on the same screen with these same 3 equations. That's fair enough, but you got to remember, these formulas rely a lot more on the assumptions than the actual equation themselves, right? The person who multiplies pre-tax by 8 or multiplies pre-tax by 10 or discounts at 12% instead of 15%, they're not going to make a big difference. It's the people that are able to make the right assumptions for the future of the business that are going to get the right valuations, okay? And really, these are just here to give you a ballpark estimate once you make all of your assumptions, okay? Ideally, you get a company that has nothing but green check marks, no red flags, and then on top of that, it's a no-brainer as far as being undervalued to where, you know, you can do these formulas almost in your head. But anyway, let's just do this. Okay, so 12 billion times 10 divided by the number of shares, so 0.443, and I get $271 a share. Pretty high from what I was expecting, to be honest. All right, next is the earnings per share and growth formula. So I do our earnings per share, which was 1320 times 8.5 plus 2 times our growth rate, which was 8.3, and I get 331. Awesome. And lastly, the discounted cash flow. Oh man, I just realized I forgot to talk to y'all about why the cash flow was so low. And they have a whole paragraph describing that in the letter to the shareholders that I thought was really interesting. The link's below if you want to read it, but you know what? I'm just going to show it to you real fast. It'll just take a second. All right, so here it is. There's just a couple of key sentences. For the full year, free cash flow amounted to about minus 159 million, in line with our expectation for approximately break even. So that's what they're trying to do, and why. If you read down here, they tell you, where is it? As a reminder, we prioritize our cash to reinvest in our core business. So right now, they're still in the growth mode. They're still trying to get as much great content as they can. So they're just using all their cash to grow. The thing is, though, if you're investing in them, you know that eventually the income that you're seeing will turn into cash, or at least you're hoping that it will. So let me go back to valuation now. Okay, so how do we estimate what the cash flow is going to be from our pre-tax income? So one really kind of crude way to do it is that your net income should be about the same as your cash that you generate, right? That's how it works in your personal finances, right? You don't really have a distinction between income and cash flow unless you're super rich and doing all these fancy tax write-offs where you're still generating a bunch of cash, but you're not paying a lot of taxes. Anyway, that's a tangent too. Okay, so I got to get from pre-tax income to net income. All I'm going to do is multiply by the tax rate. So the tax rate's 21%, so times 0.79 will get me an estimate for your net income, so 9.48. So if I put that here as my free cash flow number, 9.48, and say that they're going to perpetually grow at, I'm going to say 8%, because it was really conservative in my opinion, so I'm not going to discount it even further here, and then discount it at 15%. And I get a net present value of $155 billion for the market cap. So if I divide that by the number of shares, 155 divided by 0.443, I get a price target of, I'm going to say it, about 350. All right, awesome. So average price target is 317. To get there, the stock would have to fall, let's see, about another 20%. That's not unreasonable. I think I'm waiting for that to happen. And if it gets there, I know usually I buy under my price target, but I think we took some pretty conservative assumptions here. And Netflix, to be honest, is a business that like even I can understand, right? It's pretty easy. They don't have all these side businesses like a Google or anybody else. I mean, it is literally they pay to put on shows and then you pay them subscription fees. So you watch their margin and their number of subscribers and you pay attention to those two numbers, and I think you can be a very informed investor. To me, this is a great company. It's going on my watch list, and I'm hoping that they can drop, in that 300 range. If they drop below 300, I think it's game on for me. So we'll see. All right, so I know this video was a little bit different, but I hope you enjoyed it. I hope you learned something. If you did, like and subscribe, and I'll see you next time.